bad joke. Dropped at the first sign of trouble. They're only as good as the world allows them to be. I'll show you. When the chips are down, these civilized people, they'll eat each other. See, I'm not a monster. I'm just ahead of the curve.
The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4%, and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again, blame anybody, but if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
What is going on, YouTube? It's Brendan from Market Makers. I hope you all had a fantastic weekend. I know some of you are probably disappointed. Why no funny intro today? Why no dance music today? Guys, I wanted to play that clip that was John Kennedy questioning. I've played this clip before, questioning Powell about inflation, the battle for disinflation, and what it does to unemployment. It's very important to understand because the mainstream media narrative is still what? The economy is resilient. The consumer is resilient. This takes time to erode in this cycle of decay, and the greater risk is to the downside. That's why we're wearing shorts in this market. That's why I've been giving you these winning trades in this market. Guys, we need to talk about this really quickly. I'm going to go over the charts, go over the trade setups, show you where rebounds could potentially go if you did miss the opportunity to trade anything that you want to trade. This is an important video, as all these videos are important, and this week is earnings for Apple, for Microsoft, for Google, for Meta. So you're going to, actually Apple's the following week, I think, but you're going to have key metrics come in the marketplace. The market just finished its presidential cycle, or it's finishing its presidential cycle rally. October 1st to April, that period of time going back to the 1930s, I think 1932. It's the strongest 7 months in the market, stronger than all the other years combined, okay, for returns. And that rally is all but over. Could we get a little pop from big tech here? We could. We're going to look at the upside risk. Could we get a little pop from the FOMC meeting to come just after that next week? Yeah, we could. We're going to look at the upside risk. But the overall direction is down. What Kennedy said 10 times when the Fed was fighting inflation since the 1950s, all 10 times, all 10, for inflation to move down 2% required unemployment to go up 3.6%. Lee, throw up our unemployment recession chart. And Powell replied, yes, that's been the standard to have a recession and to have unemployment go up. Look at the chart, ladies and gentlemen. When people say, well, how can we have a recession when unemployment right now is at a 54-year low? That's peak cycle. That's peak economic cycle. The economy has nowhere to go but down. If you look at the chart, unemployment in these cycles is always at lows, historic lows, before it spikes up. And when does it spike up? You see the red lines on the chart? After the recession, and that recession is coming. So the reason I'm bringing this up, guys, is because historically, to get inflation down 2%, remember this last 3-4% is the sticky part. To get inflation down 2% more from where we're at, you're doubling your unemployment from here. You'd be at 7% unemployment. To get inflation down to the Fed target of 2%, you're looking at over 10% unemployment. Important concept to understand, because this is going to be reflected in the stock market, my friends. It's going to be reflected in the crypto market. You can't have 7 to 10% unemployment and have a bull run. This is why historically, through all of market history, you have never had a bottom in the market before a recession. So for everybody telling you on TV that, oh, well, the market bottomed out in October, the market's a forward-looking indicator, it priced in a recession. No, it did not. Why do we know that, guys? Because historically, every single recession, the S&P trades a third off of its cycle high. That brings you down to our FOMO target, minus 35%, 31.41. You're trading at 41.30. You're going to drop 1,000 points. You have not priced in a recession. I want to reiterate that because I know a lot of people are going to get hurt thinking this is a bottom and you're going into a bull run. You are not. It has never happened historically. Again, more money has been lost in trading, guys, with that mindset of this time is different. All 10 times the Fed fights inflation since the 1950s, all 10 times resulted in unemployment going up by 3.6% for every single 2% drop in inflation. Understand that ratio. Doubling and tripling our unemployment numbers is going to be reflected in the markets. That's people losing jobs, people losing their homes because they can't pay their mortgage. That's people not buying consumer goods. Remember, 70% of our economy is consumer good driven. So the fact of the matter is it takes time. Coming off this presidential rally cycle, guys, we're going back into May. And in May, the pain will start again. We have our pivot cycle we talked about. By the way, should have been some bragging rights, which I didn't brag about this at all, as you guys know. Our April 14th pivot. As of right now, how accurate are our pivots? Every single pivot has been a key inflection point in the market going back to the summer of last year. All of them being the exact high or exact low in the S&P, with the exception of the last two. The previous pivot here on February 14th was within $20 of the high. The current pivot was within $10 of the high in the range for now. But you know what else it was? It was within the $1 on gold for the high. It was the high for Bitcoin, April 14th, before its decline. Understand, this is why we cover the S&P. $35 trillion market cap. The algorithms are buying all of these markets. These markets are connected. It's the same reason you can trade the DAX and the French 40, because they all relatively bottom and rally and decline at the same time. So it's really key to understand how all the markets are interconnected. If the largest market rolls down, the other markets, the other risk assets will come down with it, guys. Really want you to understand that. So understand, unemployment is the last thing to spike. That's the end of that summary. So that's going to happen. Going into May, the decline will resume, I believe. Looking at our chart, so where are you guys trading at here on the chart? Remember, 41.43 to 41.73 has been our range. We have many people in our Discord been in and out of trades here. Some people holding, waiting for the larger drop. This is setting up just like our previous pivot. You're making a distribution box, okay? So if we have some volatility with the earnings this week, check this range. We could go all the way up to 4,200. Remember, our max upside risk that I have on the S&P is 42.89. Do I see that happening? No, that's why we're in shorts. I got in shorts on the pivot on the S&P, and that went up to, where did it get up to? 41.65 almost, okay? And your high so far since the pivot has been $10 above that, 41.74. So that's what you're looking at as a trading range for a good entry. And anything above that, guys, the way I'm viewing the market, any rallies that you get and Bitcoin and the indices and the individual stocks, the trading ranges I gave you, when they are reactivated, these are opportunities, of course, being as high as possible in those trading ranges, depending how strong any rally would be. These are opportunities to profit in the decline. You got to understand the overall direction of the market, and the overall direction trading in a bubble is down. All rallies should be faded. Guys, if you want to learn how to trade these markets, if you want to be around a community of traders, come check out our Discord. That link is in the video description. You would absolutely love our room. You get a half dozen custom-made indicators for free, and the exchanges, SimpleFX and BingX, will pay for your first month for free to check out our room, and you get to keep all the indicators. Download those apps. They're in the video description, one of the two. Check them out, guys. One of the two apps, and message Lee in the Telegram. All that info is pinned as well in the YouTube comments and in the video description. Lee, go. I want you guys to check out SimpleFX. Check out this app. They upgraded their app. It's fantastic. We put together a little compilation here so you guys could see the app. Lee, go ahead and run that quick clip, and then we'll come back on the other side. So that's a SimpleFX trading app. That's the mobile app, guys. It is absolutely fantastic. With our link, you do get up to $5,000 instantly available in your margin to trade with. That offer is exclusive to us. There's nobody else that can give you that offer. They are a fantastic partner here at Market Makers, or a sponsor here at Market Makers. So really do appreciate that. You guys check them out. You'll love to trade there. All right, let's go ahead and jump more into this, guys. Looking at the S&P again, let's look at our money flow. You're still in the bullish territory. Your buying volume is down. You're at 50. Where are you at now? You are at 56% of the individual assets in the S&P 500 are above their 200-day moving average. Just 56%. That's the market breadth, okay? It's a weak rally that's going to roll over. Again, upside risk, there's always upside risk. Upside risk, absolutely. But overall, the direction will be down. How you view these markets is very important to how well you're going to profit and trade in these markets. Looking at this on the daily on the S&P, you can see this again, 41.43. Looks like we could roll over here. I'd love to see us come up for a lower high, give us a classic double top, break our 45 angle. Again, the upside risk is the 1618. FI at 42.89. But I would not be surprised, because we only did that once back in June, or back in August of 2022. We only got up there once. This range of 41.43 to 41.80 has held going all the way back to June of 2022 for excellent trading opportunities in the marketplace, guys. So watch that range. I would wait for a re-entry point, pumping back up. I'm sure we'll get some type of stimulus at some points. Markets move in waves. As you can see on the screen, they don't just drop in a straight line. They don't go up in a straight line. So I think there'll be other opportunities, whether it's an earnings catalyst or something, some type of noise about the Fed. Maybe they're going to pause. You guys know all the bullish narratives. The bearish narrative is really simple. We kept rates 0%, had the longest bull run in stock market history, inflated a major asset bubble in the S&P, which normally goes up 10% a year post GFC. It went up 120% in like 18 months. Okay. Again, 6xing your normal 2-year return. That's your bubble. So the bear case is really easy. And now we're raising interest rates. Every time we've done this in this rate hiking cycle, unemployment will go up dramatically. You will have a recession, the 40-year high in the yield curve inversion. So the bear case is easy. The bull case is, well, maybe it's not that bad. It doesn't matter, Bob. I'm a stock picker. I am a stock picker. This is a stock picker's market. You can always find value. There's always something to find value in. If you're not going to trade, guys, if you're not going to trade, what I did, what I suggested to my family is just sit out of the market and wait for a bottom, because the bottom is not in. It has not been in one time historically going back to the 1950s, given the indicators that we have. Oh, by the way, since my last video, the LEI, the leading economic indicators from the conference board, printed its 12th consecutive month negative. Okay, 12th consecutive month. Not only that, it was supposed to come in negative spot 4. It came in negative 1 spot 2, 3xing the negativity, I guess you could say. But what's more interesting about that, do you know the last time the leading economic indicators came in 12 months in a row negative? 2007, 2008. You know what the price to sales ratio is of the market right now? The Y2K cap, okay? The peak of Y2K. Do you guys see the stars are lining? Do I need to paint a picture? Do I need to draw it out? I know most of you get it, but that's what's going on in the marketplace, and the average person, the average analyst will be behind the 8 ball and they will be late. And of course, you'll see people on YouTube who have no idea what's going on say, "Well, it was a black swan. Nobody could have predicted this. It was a black swan, right? Oh, Bob, this was a black swan, wasn't it?" And you'll see some guy named Crypto Rick or something talk about the black swans in the marketplace. Guys, these guys don't even understand the financial terminology. Black swans are unforeseen events. You're in a bubble cycle. All of this is foreseen. All of this can be predicted. So just understand that. My God, I watch some of these, so many people send me videos, and you lose IQ points watching some of these videos. People have no idea what's going on. And some of these guys have over 100,000 subs. They have zero idea what's happening in the marketplace or the macroeconomic space. Looking at the VIX, guys, that's the dangerous low from your all-time high, January 4th. Remember, the VIX moves inversely. The VVIX, so the VIX measures implied volatility of the S&P, okay? So this is also complacency, and you're at the all-time high level. When the S&P made its all-time high, your VIX was low. And then what happened? The VIX will spike up. We're getting back there, guys. It's going to start moving back up. The VVIX, which I don't have the chart on my screen, measures the implied volatility of the VIX, and the VVIX is already spiking up. It's a leading indicator to tell you what's going to happen in the marketplace. So let's go ahead and bounce over to Bitcoin. Again, guys, the April 14th pivot nailed the high, which had nothing to do with any pivot points on Bitcoin. It had to do with the pivot point on the largest market that's tradable, the S&P 500, okay? And as you can see here on our weekly pattern, our next drawdown, again, I'm looking for the high 12s to the low 13K region. That'll be your next drawdown. Look at this big bearish yellow candle, a little doji here on the weekly on the new candle. Let's look at this on the daily. Fell right to support here at 27,190. One of the traders in our room, Mark, the guys in the room know him as Marbob6, posted an excellent trade in here to capture close to this top and get this nice decline here on his trade, okay? Fantastic trade. And what you're trying to do here is base. And if the equity markets rally at all based on earnings or hope of earnings or hopium that the Fed's going to pivot, the Fed's going to pause, whatever, you could see Bitcoin move back up, guys. And you need to watch that, because if you get a rebound opportunity, these are potentially trading opportunities, understanding what's happening in the macro environment, okay? Let's go ahead and look at this on the 8 hour. So 8 hour, we had our two Wyckoff structures. Somebody asked me, what's a mini cough? Mini cough is just when I do a smaller Wyckoff structure like this. It's my term. It doesn't exist in a book. I made it up. Okay. So oftentimes Wyckoff's gold standard was the daily. He traded on the daily time frame. Most of the legends traded on the daily time frame. There's no computers, so you had to manually draw your charts out. So he traded on the daily. So when I'm on smaller time frames using a smaller set of candles, the price will move the same. It still follows the Wyckoff money flow, but I call these mini Coff structures. You form your Wyckoff trading range, your up thrust, your down thrust. And what did you do here? Lower high. Also made your double top that we talked about last video, and you shot down. And where'd you land? The previous Wyckoff trading range and the bottom of the range. Trying to put in a double bottom here, okay? Let's look at this. Could we have captured this on a fib wave? Fib wave projections are key. So let's go to our swing high or swing low. Back up to our swing high, boom, 1618, the golden ratio. The market moves in proportionality. Okay, you see this all throughout the universe. Again, esoteric principles in the marketplace. People don't know they're esoteric, but that's what Fibonacci is. That's what the equinox dates are. That's what the solstice dates are. You have to understand these concepts. That's why you hear people talk about the market. Oh, we have January season, that strong seasonality in January. That's the winter solstice / the Santa Claus rally. Oh, this is a bad season for us traditionally. You hear these expressions all the time, guys. They have to do with these dates that have held statistically over the course of the market's existence as key inflection points in the market. Pivot points, okay? Pivot points. In the Western Hemisphere, the spring equinox is planting season. That's when you start planting crops. Harvest them in the fall equinox. You see how it works? Natural cycles in the marketplace. 1618, you got a little double bottom going here. If you get any type of bullish momentum, again, I would be hesitant to short anything on Bitcoin unless we start retesting some higher ranges or until you get through this earnings, okay? But watch and see what happens with Bitcoin's price. If Google or somebody, Amazon reports strong earnings, maybe you get a rally in all the markets, but you got to look at the markets holistically, back up, bird's eye view. Is Bitcoin pumping, but everything's dumping? To me, Bitcoin's acting like a leading indicator because it is ultra risk, right? So I said that before. Equities are risk assets. Bitcoin's ultra risk. So Bitcoin dumped, and it's going to dump at a higher beta, guys. And the markets are all kind of topping out and looking anemic here. So if earnings give you any type of rally, the Fed gives you some type of BS speech about, they're data dependent, whatever. They say something that the market likes. They come off dovish the following week. You could see a good rally, and you want to look at your key areas of resistance. Looking up here at, you have 28,516, 29,265 puts you back at this base. And then, of course, your previous trading range where you got all the way up to 31. All those are possible. Bitcoin is highly volatile and able to move that way. So if you get this double bottom and it comes up, your immediate areas you want to watch, 27,983 is basically 28,5 and almost 29K. That range in here is where you want to watch. Might be able to take some scalps in and out. We do have scalping traders in our Discord as well, guys. So let's look at the NASDAQ on the weekly. NASDAQ on the weekly, here's our 100 moving average. Again, upside risk is 13,455. Here's your Wyckoff in white, okay? And you're trying to do your Livermore pivot, hold this trading range. 13,111 to 13.2s provided great scalps and great areas to hold on to, looking for the NASDAQ to decline further, which is currently at 12,925. NASDAQ again on that next wave down, looking at a mid-June bottom with the S&P going to 3141. NASDAQ going to say 9,200 to 9,500 is the range I'm looking at for the NASDAQ on that next wave down with a mid-June bottom, okay? Let's go ahead and look at the NASDAQ on the daily. Get more zoomed in view here. As you can see on the daily, ping-ponging around, and this 13,198 has provided multiple really good entries here. 1, 2, 3, 4 separate daily candles here, and you printed a disjointed double top once again here on the NASDAQ. If you lose this range, guys, you want to see the NASDAQ, which is at 12,924. It needs to hold 12,750. Okay, needs to hold 12,750. You start going in reverse here. Look at 12,522. But again, this is going to be volatile because of earnings. You could have run-ups before earnings, anticipating something good. News comes out, not as good as expected. Look what happened with Tesla. And then it comes back down again. So be aware of the ranges that have provided resistance. Again, sweet spot 13.2, okay? Upside risk up to 13.4. If this comes up to 13.4 and it holds as resistance, I'm shorting the NASDAQ here, right? If it comes back up to 13.2 and it holds as resistance, we get through some of these big tech earnings, I'm shorting back up here at 13.2 because this has provided some really nice point movement, okay? So that's what I am doing. And let's go ahead and get rid of this. Oh, one other thing I want to speak to, guys. A lot of people are asking me, what's my invalidation case for my market, I guess, thesis or cycle thesis of the market? Because I know that's really popular, especially in the Bitcoin space. I see people send me thumbnails. If Bitcoin does this, I'll say I was wrong. If Bitcoin does this or hits this price, I'll say I was wrong. Guys, you have to understand, for me to be wrong about this next wave down, you could say I'm wrong about the bubble, which I don't think I will be, but you could say that. And you could say that, with every bit of, I'm guessing or whatever, I'm over exaggerating. That's fine. But for me to be wrong about the next wave down, that means all of the indicators that have been right since the 1950s, again, would have to be wrong for the first time ever. So I'm going on that side. So I do not think I will be wrong about the next wave down. These targets will be hit because they're historical averages of where price trades on the S&P. Now, maybe Bitcoin doesn't come all the way down to 13K. I think it will, but you could make that argument as well. You could say, nah, it's just going to go to 15.5, the previous bottom. I get that, but this next wave down will happen. We're still in the beginning middle, like we're in the beginning part of the game here of what's going to happen in the economy. Unemployment's 3.4% right now. So you have to understand things are going to progressively get worse as time goes on. But my base case, guys, of having a recession and having this next wave down, it's going to happen, because if it doesn't, it will be the first time ever in market history with the indicators telling you you're having a recession. So I'm 100% confident on that call. That's what we're looking at here on the NASDAQ, guys. Gave you the levels again. If we do start declining, your 12,750 and the 12,500, your next two stops. Oh, let's look at the indicators real quick. You are bearish on the money flow. Your buying ratio here of volume has definitely gone down. It's in the bearish territory. NASDAQ 100 does have a higher percentage of stocks because this is breadth above their 200, obviously the big tech rally. Okay, so you're at 72% of those stocks, right around your peak last time when you did sell off once again. Markets move in patterns and they move in cycles. Let's look at the German 40. Okay, this is the DAX, the DAX, pumped right up to the target here, 15,974 in the daily, starting to print a double top. Lots of people ask me about lots of Americans, I should say, a lot of European viewers, but a lot of Americans ask me, can you trade the DAX? Can you trade the French 40 and not follow their economics, not follow their news? And the answer from a chart perspective is yes, okay? Because if you look at the chart, let me go ahead and throw this really quickly on the weekly just so you can see it. You look at the chart. When did the DAX make its all-time high? The weekly candle of January 3rd, and it was actually within 24 hours. When did the S&P make its all-time high? January 4th, 2022. When did the DAX make its rally bottoms? You have your March bottom, and then you have your pump up, okay? You have your pump up, and then you sold off. But the key bottoms here, look at this as well. The S&P bottomed in, what was it, June? The DAX bottomed in late June, June 27th. The S&P bottomed in October. When did the DAX bottom? October. It's the same for the French 40, okay? You start to get within a week of each other on the bottoms and the rallies and the sell-offs, but they're moving cohesively together. The difference about the DAX and the French 40, the CAC, why I like it is this parabolic explosion up. This notion that it's better to be in the European markets than the American markets. The reason you got this parabolic rise, in my opinion, is because you were lagging behind us in your interest rate hikes. What are you at now? 3%, 3.5%. ECB meets next week as well. We're already going to be over 5% if we get this next rate hike. So you had more growth here in your equity market space. You were able to sustain your rally because inflation is actually good in some aspects for earnings for companies, and you have an explosive rally, but this is going to give you dramatic declines because again, when you look at when the S&P sells off versus when the DAX or the French 40 sell off, they line up beautifully. You know what? We can go ahead and show this instead of just taking my word for it. Let's just look at the S&P. Let's do new pane S&P. Throw the S&P. Oops. Actually, that's not the option I wanted. Let's go ahead and take that off. All right. This is how you know we're doing this live. Let's take that off. All right, so let's go ahead and do it this way. We'll do S&P and let's do same percentage scale. That's what I wanted. All right. Again, guys, let me get this a little bit opened up for you. Look at your peaks. Here's your S&P in orange. Here's the DAX. There's your bottom. You see your base. There's your base. There's your rally up. S&P starting to roll over. DAX is hitting key resistance. Okay, you can overlay these charts yourselves, but overall, the equity markets are going to, by and large, track together. They will descend at different percentages. They will rise in different percentages. But this is an opportunity for somebody who likes to short markets, in my opinion, which I do, to trade the DAX and trade the French 40. Actually, let's go ahead and go over these numbers. Get rid of that. Boom. Okay. So we have 15,974 again, upside risk potential above 16.2. Okay. So we can go ahead and throw this on here. Let's just throw on another fib so we can see what that number would be. And get my 1414. That's 16.1 and 1618. 16,281 is your upside risk potential if the DAX does want to break out, and then you're hitting your all-time high levels. Okay. So and a short here on the DAX, and a short on the CAC, and a short on the SPX. And I'm waiting to see if we get some follow through to the downside. Looking at the French 40, guys, 75.58 was my pattern target. Found another fib retracement here, or fib projection, I should say, 75.98, which we hit beautifully. And this is holding up. So I like these two areas right here where the CAC is for potential entry. Upside risk potential to 77.39. And again, all this is going to matter with what happens with the S&P. S&P starts to roll over. And by the way, these same dips that you have on the DAX and the French 40 here, when was this, guys? This is Silicon Valley Bank. US indices rolled over. The European indices rolled over. And of course, you got Credit Suisse out of that, and a little bit of a scare with Deutsche Bank as well. So this is right now in this topping type phase. We'll see if we start to hold this range. If we start coming down 74.87, 7,400, and then you start declining from there. Obviously, there'll be more updates as well. In the daily time frame, volume dropped off a lot here. Money flow is starting to peak out. You are overbought. Volatility is low. Looking for the next volatility move up, which means price would be dropping with increased volatility. Ethereum is trying to hold. Watch for 1795 to get hit. Guys, the area you have to hold on Ethereum, you really want to hold this 1700. See this cluster of candles here as well? You want to hold this 1700 on Ethereum. If you get any type of rebound, pull a fib retracement from your high down to your low and look where you could potentially bounce up to. I focus on the 618, 786 are my key retracement areas that I like to look at if you do get any type of formations of double tops, okay? So you'd be looking at 2017, 2074 if Ethereum does bounce back up. Again, for those of you that like to trade cryptos. And eventually, guys, when this does start caving and start moving down more dramatically, watch for 1424 to get hit, which puts you back in the bottom of this range. And you can see Ethereum on the money flow, bearish. Volume dropping off, volume ratio switching from buying to selling. Looking at Tesla, guys, one of the key shorts. So proud of this short that I gave you guys at 208 because that entry is just so beautiful. Give you that 2.8. Where's Tesla? 160. Watch for Tesla. It needs to hold 146. Look at this gap here on the 3-day chart. It needs to hold 146. You lose 146. Watch for 126. Watch for $100. You're low. Tesla is kind of acting like Bitcoin, is that the decline is much greater here in Tesla. Guys, most of these stocks, you got to understand in bubbles, it doesn't matter how much you love a company, how much you love a crypto. Tesla was $23 in the pandemic and it got up to $412. The PE on Tesla, I still think is above 40 right now. Look, you have a historic norm where you're going to trade in these markets and it is much higher. Brightness went down. Much lower than the norm of a lot of these overinflated tech stocks. You got Nvidia way overinflated, Tesla still way overinflated. You're going to see a drawdown of Apple and Microsoft at 26 times and 32 times. All of that's going to come down. The mega caps are holding up the space, and when they start to bleed, everything else will bleed even more. So watch these key Tesla levels as you do decline. Looking at Nvidia, speak of the devil, and then again in this confined range here, basically a Wyckoff range of 263 to 279. So I think you're going to be in this range. So you have a catalyst. The catalyst could be when Nvidia reports earnings, what their guidance is. A lot of AI hype in here, guys. I think this stock is up, 90% since January. I think 150% since the presidential rally cycle. So this is going to be giving up a lot. And on the daily here, I mean, not really any type of clear pattern. It's just volatility in this range. But looking at your areas to potentially trade this, bounces back up to 279, upside risk to 288. This has provided excellent entry points. This is how you need to view the markets. Excellent entry points. So NVIDIA gives some type of positive speech, positive guidance. Market really likes it. Watch for these areas at 288, 279 to potentially get hit. And again, depending how you view the market, if you view it like me, that is a potential trade I will be taking on NVIDIA. And let's go ahead and look at MicroStrategies. I'm so glad I posted this trade. MicroStrategies, I said I like the short up here above 333, upside risk to 360. It got to 347, guys. MicroStrategies obviously following Bitcoin down. And of course, looking at the 618 key support here, guys, at 273, you want to hold that. Beneath that, 228. 180, and you're starting to really fall at that point. I think, again, if tech does put in another rally, you'll see a little bounce back up. So range is the same here for me, 333 to 360. Excellent opportunity to get in this as well. You can see that same range was hit here, hit here. Look at that decline, expecting the same. And as the markets pull down, you'll be going deeper than that. Looking at 102 target for MicroStrategy to hit and the next wave down. And you are at 285. This is the fun and joys of trading individual equities. All these are available to trade on SimpleFX, by the way, guys. So definitely check out that app. For solar, again, that same range I gave you still holding true. Up thrust in the Wyckoff range, anything above 217. Upside risk to 228. Max upside risk 244, which no indications you've got anything near that. Obviously, you gap down here on the daily chart. You're at 206. Same story, guys. Come back up to the 217 trading range. Get some news. There's some bullish news about solar the other day, which is why you had this rally back up. But these are areas of resistance that have held and have provided profits and trades for us. So these are the same areas I'd be looking at. All these entries, anything above 217 on bullish news. This is going to go down a lot as well. This is up massively as well since, I guess, last summer. Massive. Look at that rally. Massive gappy rally. So again, the 1618 I have on First Solar is down at 123. It's trading at 206. Looking for the next pull down to bring this back down to reality to 123. All right, gold and silver, wrapping this up. So did you notice, one of the guys that I referenced before, George Gammon, great channel. He does a lot of deep dives. Doesn't give trades, doesn't talk about his trades or anything, but does deep dives on specific issues. If you like economics, guys, he just put out a gold video. Gold is going down. I saw another big YouTuber put down a gold video calling for 1,000-point sell-off. This is all since last week, okay? All since last week. Been talking about this for weeks and weeks. The weeks roll together. So if I say months and it's been 5 weeks, I'm sorry, guys. I don't keep track of the weeks. But again, historically, we've been talking about gold potentially going down for months now. Months, because in GFC, it did the same exact thing. Now, this to me, what we're printing here, getting cutting edge commodities information here, guys, because in recessions, you will have a decline because economies grind to a standstill. So this to me looks like you're printing this. Again, a distribution box. You will have other opportunities here if you do want to ride the gold bull potentially down before you have a nice parabolic rise up. We didn't get there on the MFI, guys. Look, when I'm doing trades and I talk about, and again, this is my system, okay? You guys have your own systems, how you trade. Go by with what works for you. But when I'm analyzing a chart, and I see a chart set up with my MFI hitting overbought, hitting above 255, overbought, right? Overbought. And then looking at the drops I get when I have all the confluences, that gives me a high probability trade. We never hit overbought here. You could still have a rally up. This is why I'm not jumping into this, even though we're clearly getting rejected at some levels. We have a nice double top here in a volume ratio, but I don't have all the confluences I would want to see to potentially give myself a high probability trade. We didn't get to 255 or above like we did here, but I still do think when the markets pull down, gold will pull down with it. And the first area you want to watch with this, guys, is what? Your lows down here, 1626. It's also the 1 fib on the trend based fib. And if it got really dirty, really nasty, repeating the GFC cycle, you're looking at 1521 to 1389, 32% drawdown because you had a 34% drawdown in the GFC. And if we look at silver really quickly, same story here, guys. We got slightly overbought, but not massively, but it's going to track to gold. So if gold gets overbought, silver could range in this range, come up a little bit higher. So my take on it is metals could still move up. It's not worth the risk. Everything's about risk premiums, right? It's not worth the risk to me when I'm looking at other assets that are definitely showing me better signs of confluence. But this is still a great area if you do decide to do something on a trade. 25 spot 447 is this fib that's held up now here on the 3-day charts for 3 candles. So that's where you're at, but you're not strongly overbought here. Gold's not overbought yet, so you could have more upside risk to that 26 spot 99. Be aware of that. Maybe better entries here in the near future, or maybe not. It could just roll down and fall apart. Leave me your comments. I will answer them as always. Like, subscribe, project this video out into the algorithm. Really do appreciate your guys' help and support. And I'd love to see you in the room. Check out our room. Message Lee. He'll help get you set up, guys. Take care, everybody. Talk to you next video.